must say, it's a really tough call coming on after Luke Johnson on a Sunday morning. I think that's just unreasonable to be expected to do that. When he was going on about being a cold and timid soul, I thought that's me he's talking about. But anyway, I'll just have to do my best, because my subject, I'm afraid, is not how to make a fortune out of Four Seasons pizzas, which, by the way, I strongly recommend, or out of Gale's cappuccinos, which I think are the best in town. I've got to talk to you about banks. Sorry. Anyway, that's what I'm going to do. And my exam question for the morning is, can banks be reformed? The answer in a single word is, of course they can. Yes, they can be. And the second question is, can they be reformed in a way that isn't going to crush the life out of our economy, nail poor old Luke Johnson into an early grave, and throw us out of work? The answer again is, yes, it can be. But then the difficult question is, are the reforms that are already in place or have been promised by governments here, around the rest of Europe, around the world, are they going to be enough to restore stability to the financial system? Are they enough? Are they going to do the trick? And here the answer is more qualified, because there's still a deal of heavy lifting to be done before we can stop worrying about the way our banks work, and this matters. Of course, we depend on sound banks for the workings of the payment system and for the security of our savings and loans. Credit fuels the economy, fires Luke, creates jobs. And as we saw in 2008-9, the cost of banking failures is multiplied many times over by the impact on the overall economy. Massive loss of output we saw then, massive losses of jobs, huge cost to the taxpayer bailing these things out, shortfalls in tax revenues. We absolutely cannot afford, as a society, economically, socially, or politically, we cannot afford an episode like that anytime for a very long time to come. It would be a catastrophe. So my talk this morning comes in three parts. I'll start off with a case for the prosecution. The arguments advanced by those who claim that the changes now underway in banking amount to little more than sticking a bit of elastoplast on the vast and gaping wound. That the system, as is currently shaped, just can't be satisfactorily reformed. Instead, it has to be radically restructured. I'll go on then talk a bit about the reforms that are underway and have been promised, and discuss how far they might go to ease the worries. And I'll conclude by suggesting what more could and I think should be done. We'll have plenty of time for discussion. I hope. I'd be very keen to hear your views. So the first question under this heading is, what is there left to worry about? Haven't we already seen a lot of concerted action, both at a national, European and global level, since banks around the developed world started to slip down the plug hole in 2007-8? Doesn't the system look a lot more robust today than it did back then? And of course the answer to that is, yes, it does. It is more robust. But the case for the prosecution is that the changes to the banking system that we've seen so far amount to little more than fine-tuning the existing model rather than coming up with different and more sustainable structures. After all, after the great crash of 1929 and the banking failures that followed everywhere in the developed world, radical changes were made to the way the banking system worked. They were led by the United States with a whole raft of legislation, including, of course, GlassSteagall, which built a wall between investment and commercial banks, and helped build decades of financial stability in the rich world economies. Banking became boring. Successful bankers were well paid, but they didn't become super rich. Banks pretty well everywhere worked on the 3-6-3 rule. That means they would take in money in the morning and pay 3% for it. They'd lend it at lunchtime to somebody for 6%, and at 3 o'clock they'd be out on the golf course, 3-6-3. In the UK, this is known as the Dad's Army, Captain Mannering style of banking, which people start to think back to. The reforms that have been driven so far over the last few years have been nothing like as radical as those that followed the crash of the early 30s. And the critics say there are already worrying signs that the bankers are starting to play once more the games that helped to bring the global economy practically to its knees in 2008-9. This is especially true in the US. Their banks have adapted much more rapidly to the changed environment than their peers in Europe. They've moved more aggressively to rebuild their balance sheets. They're now in quite a strong shape for expansion, and craziness is just beginning to be seen in the air again. So debt levels in the US on leveraged buyouts, on big buyouts, in the final months of last year were back to what they had been just before the crash in 2007, a sign that bankers are prepared to take on a lot more risk again. Issuance of collateralized loan obligations, don't worry too much what they are, they're just things to worry about. They're back up to what they were before the crash now. There's evidence that a growing number of investors are willing to accept what the Bank of England described the other day in a very Bank of England-y sort of way as low-quality, complex, and opaque collateral. It's what you and I would probably call junk. And there are other obvious signs that perhaps things haven't changed all that much either. Because the bank bonus season is with us again. Gets cranking up in big time tomorrow, actually. Oh, no, on Tuesday. And although the banks will tell you that they're being much more parsimonious and cautious these days, the numbers will still look outlandish to us mere mortals. The fact that these big bonuses still exist can still seem to make sense to pay great sums of money to individuals in return for generating vast profits tells you that this is still a risky game. Boring companies, indeed boring banks, and there are some of those still around, don't tend to pay massive bonuses. They can't afford to, and they don't need to, because they don't operate a star system. And because they don't take the risks that generate these vast rewards, boring banks don't tend to go bust. So we'll see from the bonus announcements that will be coming in the next few weeks that this is still a business that generates a lot of very profitable froth for the winners and very big risks as well. And it's also one which still has lots of balance sheet problems. If you look at the numbers, particularly in the periphery of the euro area, you can still see that there are a lot of balance sheets out there looking very fragile. The value of shares on some of these euro periphery banks, and actually some in the core euro area as well, still well below the value of the assets as they are presented in their balance sheet, which tells you that investors don't believe the balance sheets, don't think that the banks have taken the write-offs that they're going to need before they get back to dry land. And we'll probably learn more about this in the coming months, because the European Central Bank is going through a big assessment of the banks that are due to come under its supervision in the summer as the European Central Bank reaches out over the banking system of the Eurozone. It's making everybody kick the tires, test stresses, do everything else. I saw a report the other day that the result of this examination could be a requirement for banks to raise anything up to 100 billion euros of new capital to get into a stable position. Quite where that would come from, nobody seems to be quite sure. Here in the UK, the banks are looking more resilient than they did 5 years ago, but then they needed to. A number of them have raised new capital. Underlying profits are rising. They've reduced their reliance on wholesale debt and have a more conservatively structured balance sheets with a lot more of our deposits in them. So that's all good. But the UK economy is still carrying a vast amount of debt. If you add up government, corporate and household debt together, it amounts to well over 250% of gross domestic product, rather more than it did at the time of the crash, and way above the similar figure for the US or the core European economies. And the current economic recovery, as we know, is being driven in good part by yet another big crank on the debt-making machine as the housing market comes back to life and mortgages start to get issued again. So it's just as well that interest rates in this country remain as low as they do. A lot of families, getting on for a tenth of all households on one estimate, would be in serious financial difficulties if mortgage rates were to move up by just 1 percentage point. How long will interest rates remain at their current low level. You probably have a better idea than I about that. Already, the Federal Reserve in the US is starting to become less accommodating. Here in the UK, we're going to learn more this week about how the Bank of England is going to play interest rates. On Wednesday, it's due to publish its inflation report, which will be worth looking at, because this is when the new governor is going to have to tell us how he is going to change his guidance from that which he gave last summer, which suggested that the bank felt interest rates weren't going to move up till for another 2 or 3 years even. Those assumptions now look way out of date, and the governor's going to have to come up with some different ways of telling us what's going on. He certainly won't want to scare the horses and raise the spectre of the kind of interest rate increase that would put paid to the current economic recovery. That would be bad news for the banks as much as it would be for us. Because as the Bank of England itself said just a couple of months ago, a shock to long-term interest rates could be amplified in financial markets, leading to disorderly losses for the banks. So, worrying stuff. Meanwhile, banks in this country are still being found guilty of bad conduct or worse. Fines and levies imposed on UK banks since 2011 now amount to more than £20 billion. And a lot of that, it's true, relates to activities that took place before the crisis. The most obvious example being payment protection insurance, where the total bill for that scam itself is likely to amount over time to more than 20 billion sterling. But it's not all ancient history. Lloyds was fined £28 million just before Christmas for sales incentives that were so perverse that luckless employees in branches were selling inappropriate stuff to themselves and to their partners and to their neighbours in a desperate effort to meet their sales targets. 2 more banks, we were told last week, are now being investigated for the same thing. In the case of Lloyds, this was going on as recently as 2012, way after the crisis. Just last week, again, in a different subject, the bank regulator told us that manipulation of the foreign exchange market by banks, this not just UK banks, by international banks, could turn out to be at least as bad as what has already been exposed in the LIBOR market, London interbank offer rate market. Now, since banks around the world have already been fined or had to pay settlements of $5.8 billion in respect of the LIBOR affair, this foreign exchange story seems likely to add up to another black eye for the international banking system. And again, the suggestion that this stuff was going on after LIBOR had been exposed. Had these people learned nothing about the risks of this kind of activity? And meanwhile, the critics say the big banks are still fighting a rearguard action against extra regulation. Share prices of the big European banks all jumped up last month after central bankers and supervisors meeting in Basel in Switzerland decided to water down the proposed international standard for stronger bank balance sheets. That could have cost, on one estimate, that standard, if it hadn't been changed, could have required the banks to find another $100 billion of extra capital. Other attempts at the European level for structural change don't seem to be going anywhere. Big ideas about a banking union, they've seemed to have pretty much dissipated. The famous Liikanen report, which came out whenever it was this time last year, a bit longer, that's going nowhere. A couple of weeks ago, Michel Barnier, the Single Market Commissioner, came up with proposals that would force a significant restructuring of the big European banks. But with a new commission to be appointed later this year, this move seems to be more about political manoeuvring than it does about economic outcomes. No point in holding your breath for that one, I don't think. So the prosecuting case concludes not all that much has changed. Some banks are still too big to fail. Indeed, a number of them have actually got a good deal bigger since 2007. If things were to go wrong again, governments would have no choice but to step in again with incalculable economic and political consequences. And back here in the UK, these critics add, there are still structural problems as well. Most particularly, people talk about lending to small businesses in this country, which is dominated by a tiny handful of giant banks, much more closely consolidated here than in Germany or France or the United States. And all of this helps to explain why a full 6 years after the banking crash, critics continue to call for radical surgery to our banking system. Ed Miliband, the leader of the opposition, calls for a cap on the size of the big British banks and for breaking them up into smaller bits so that they would be forced to compete more aggressively across the country. Others go back to the old idea of splitting retail banks and investment banks completely away from each other. In their words, casinos don't fit comfortably alongside utilities, which is what these critics would like retail banks to become. The third, and I think the most compelling group of critics, are those who argue that the only way to take excess risk out of the banking system is to force institutions to hold more equity capital, a lot more equity capital. The best argument I've read along these lines comes from two financial economists, Anat Admati and Martin Hellwig, and in their book, which I recommend, The Banker's New Clothes, they argue that bank balance sheets are still carrying way too much debt relative to the size of their equity capital. This means they can make very high returns in good times, but it also means they can get wiped out in bad times. Their loans still have to be repaid if the value of their assets go down, and their thin sliver of equity capital has to take the hit. So these two economists say that banks should finance themselves much, much more conservatively by building up the equity capital to a level that would be 2 or 3 times that currently being envisaged by the international banking authorities. That's the kind of talk that gets bankers choking on their cornflakes. But is it right? Is it correct that that's the only way forward? I think it's now time to set out the case for the defense. And a starting point is that the structure of, or the architecture, the regulatory architecture for banks, particularly in this country, has changed completely over the past few years. And some of the most radical changes have been actually here in the UK, where they certainly needed to be radical. Our banking system is very large relative to the total size of our economy here in the UK. Our approach to regulation showed dramatic weaknesses in the run-up to the crash. And that combination is one important reason why, until recently, economic recovery in this country had been so much slower than in most other advanced economies. I'll just mention a few of the changes that have taken place here so far. One that I don't think has received enough attention is the creation of the Financial Policy Committee at the Bank of England. This is intended to address what turned out to be one of the critical weaknesses of the old regulatory regime, which was that the authorities failed to give enough attention to the overall riskiness of the banking system. They might crawl all over the operations of a single bank, but they didn't recognize how weaknesses, maybe not such big weaknesses, but weaknesses spread across several institutions in the banking system could come together to create a financial earthquake when things started to go wrong. To use the regulators' jargon, they didn't think enough about macro-prudential risk, and that's a good reason why we had such a catastrophe here in this country. And that's what the Financial Policy Committee is designed to do, and it's beginning, I think, to have an impact. In 2012, it warned that UK banks taken as a group were too heavily exposed to the vulnerable economies on the periphery of the Eurozone, and it told them to do something about it, and they did. Last year, it told the Prudential Regulatory Authority, which is the new regulator for banks, it told them to take steps to make the big UK banks and building societies raise the proportion of their equity in their balance sheet by the end of the year. The Prudential Regulatory Authority did, and these institutions did so too, plugging an aggregate capital gap of more than 27 billion in the process. And this Financial Policy Committee, I think, is just the start. Just before Christmas, the coalition government's main banking reform proposals passed into law. These will bring changes on many fronts. High street banks will be ring-fenced by a wall of capital to cushion them from investment banking activities in the same institution. Many of the practical details of how this is going to work out we won't know until secondary legislation comes through the House of Commons this year. But the intention is clear. The intention is that investment banks will no longer be able to benefit from the lower cost of capital of their retail associates, and their speculative activities will no longer threaten the stability of their retail clients. Lots of other important changes are contained in this new legislation as well. One, I think, is more about kind of political headline grabbing than about real change. This is the new law that says bank bosses could be criminally liable if they behave in a reckless way, in a way that kind of wrecks their institution. I don't quite know how that would work. I mean, you could easily argue that Fred Goodwin at the Royal Bank of Scotland behaved recklessly by pressing ahead with a massive takeover for cash at a time when the wheels were already falling off the international banking system. But his actions were approved at every stage of the way by the bank's board. Would they all be potentially liable as well? I think more meaningful are the new definitions and requirements being placed very properly, in my view, on senior managers in bank leadership. Among other things, it is impossible now, I hope it's impossible, to imagine, I don't know if only people from the United Kingdom will understand what I'm about to say, it's impossible to imagine that the Reverend Flowers would have made it to the chair of the cooperative bank under this new regime. The regulators might not have spotted his penchant for crystal meth and crack cocaine, but they would surely have picked up the fact that when it came to estimating the size of his bank's balance sheet, he was out by a factor of 10. The whole thrust of this new legislation is to make senior executives more accountable for the people working for them. It won't be enough to say that you didn't know somebody in your department, someone in your division three levels away from you was up to dirty tricks. That won't be enough. Instead, you'll have to prove that if you're the boss of such a person, that you are not yourself culpable and responsible for this behavior. In a sense, you'll be guilty until you can prove yourself innocence. There are no doubt, I don't think there's any doubt that these are big changes, and there are others. They haven't had time to take effect, but I think they will have a significant impact on the behavior of senior bankers. At the same time, the tone coming from the top of the British banks themselves, actually in the other banks around Europe, has changed significantly in the past couple of years. Most of the more flamboyant figures have disappeared. Banks are no longer setting themselves public targets for profitability, public targets for return on equity. That could only ever be achieved by extreme risk-taking and by very high balance sheet leverage. Bank leaders whose sole sense of purpose seem to be to maximize short-term earnings have been replaced by others who talk about a wider social purpose and a responsibility to customers. Barclays is an obvious example of this, but it's by no means the only one. And it's in this context that I've been asked by the chairs of our biggest banks and our biggest building society to design a new professional body aimed at raising the standards of conduct and competence across the British banking system. A professional body which is intended will apply to everyone, whether they're in the investment or the retail banking business or corporate or whatever, whether they're British-owned or foreign-owned, whether they're a tiny startup or some mega new behemoth. Quite a challenge. I'd be happy to talk about it in the discussion period if you're interested. I'll be setting out my ideas for consultation in a paper to be published on Tuesday, which is why I'm going to dash off after this talk. The point to make here, simply, is that the chairs of these big banks really do understand that things have got to change. They understand that their license to operate comes from society as a whole, and that they have to earn back the trust that has been dissipated in the past decade or more. Also, that the time for action is now. As I said at the outset, though, there is still a lot of heavy lifting to be done. The leadership of the big banks realize that their world has changed and are acting accordingly, but it's not clear how far this understanding has penetrated through their institutions. A few levels down from the top, I think it's perfectly probable that some people remain in denial, and bad things, as I've said, continue to happen. So what's the way forward? Radical surgery, perhaps along the lines proposed by Ed Miliband, or sticking to a more graduated path of reforms of the kind that are now coming through the system. Before coming to your conclusion, I'd like you to consider some other factors, take a few other thoughts into consideration. One is technology. The digital revolution that has already swept through so many industries has so far only had a limited impact on banking. But it is now beginning to make its mark, especially on the retail side. I don't know about you, I can't remember when I last had dealings with a physical branch of my bank. In 10 years' time, this business seems bound to be completely transformed, as again, Luke was touching on 20 minutes ago. Most people will be doing all their banking online. Powerful new forces are gearing up to come into the banking world. Firms like Tesco and Sainsbury being a particularly obvious example. And then there are some interesting startups nibbling away on the corner. Firms like Metro, I don't know if you had a chance to go into a Metro branch. It doesn't look like any bank branch that Captain Mannering ever knew. Handelsbanken, which operates on a completely different business model and a very successful business model from the British banks, is expanding rapidly across this country. Crowdfunding and peer-to-peer lending are beginning to have an impact, especially in small businesses, small business loans. No one knows how far that could go, but I think it certainly has potential. When I'm thinking about this, I think of other industries that in the past have appeared to have unassailable competitive strengths and how they have been undermined by new technologies and different ways of doing things. Think what happened at different stages to IBM and Microsoft. At different times, both those companies appear to have an absolute arm lock on their world, and competition regulators in Brussels and in the United States desperately trying to find ways of levering them apart and getting new lifeblood into the marketplace. Then technology, new forms of competition changed their marketplace, and their market position changed with it. I could easily imagine similar forces sweeping through the banking system over the next decade. So for all these reasons, and perhaps for the fact that I'm a conservative old geezer, but anyway, for all these reasons, I'm not one of those who think we should take an axe to the current structure of banks in the United Kingdom. Such moves would be costly and would take time. They would lead to prolonged uncertainty at a moment when the economy finally appears to be lifting itself onto its feet. And changes in the way that the banking system operates, technological, competitive changes, could make this surgery redundant. I do think, though, that we need a serious debate about the amount of debt that banks should be permitted to carry on their balance sheet. It is absolutely clear that the ratio of equity to debt held by the developed world's banks at the time of the financial crisis was far, far too low. The position has improved, but is not yet secure. Now, banks can come up with all kinds of reasons for not being more conservative, and we could discuss that, if you like, in the discussion period. But these arguments are self-interested, they should be tested, and they do need to be challenged. My main conclusion, though, is that a new picture is emerging here in the UK of banking. A new sort of jigsaw puzzle is being put together. The two major pieces of this puzzle are a new and much more challenging regulatory structure, which is now slotting into place. And the other one is a different style of bank leadership, different people, different motives, different sense of purpose among our bank leaders. A third and much smaller piece of the picture will, I hope, be a more professional approach to conduct and capability, which is what I'll be talking about on Tuesday. Taken together, along with the right mix of capital, these changes will make a difference. I think we should give them a year or 3 to see how they settle into place without throwing up everything into the air and starting again. So yes, I do believe that banks can be reformed and that at last, change is on the way. Thanks very much.
We now have 10 minutes for questions and answers, so if you'd like to put your hands up. Yeah.
Gentleman there.
Thank you very much. Thank you very much for your speech. Talking about reforming banks and the financial system, some economists argue that inside trading it's actually a good thing. How would you comment that? What do you think about inside trading?
I think it's nuts, that argument. Try and explain that to your auntie. Obviously it's true that giant brains like old, what's his name, the Nobel Prize winner in the United States, Stiglitz, makes a robust case for insider trading being a good way of clearing markets and getting efficient prices. We know what efficient prices are. We saw them. We saw the efficient market theory being blasted to kingdom come in 2007. I think that a culture which argues that robbing your customers is a good thing makes no sense at all. Yeah. Oh, up at the top.
Yeah, thank you very much. One of the key principles of internal organization is that you always get what you pay for. So it's always about the incentive structure that you give your employees.
Yeah.
And do you think that with the amount of banker boni still going around and the incentives that are still given to top-notch traders, that actually enough internal change occurred in banks to prevent a similar crisis? Even if we have bigger equity buffers and so on, they can only account for so much while we still give incentives to completely spin out of control? Yeah,
no, I think that's the $64 question, and I think behaviors are driven by incentives. And by the way, not just at these huge, very highly paid levels. The Lloyd's case that I was talking about, the people affected by that were on salaries of less than £20,000 a year each. If they met their sales targets, they got a £1,000 bonus. If they didn't meet their sales targets, their already not generous salary went down by £2,000. Those are seriously perverse incentives. I think that a lot, that a lot has been done to make the incentives less crude than they were. In other words, that generating an immediate profit or an accounting profit and taking the cash now when the cost would only emerge 5 years down the road. A lot has been done to change that, and that it's no longer quite heads I win, tails you lose. I either make a load of money or the taxpayer bails me out. It's less crude than that. But I do think that as I was saying in my talk, that the scale of bonuses still implies that this is a risky system. Where I hope you're wrong, but I may not be, is that increased levels of capital held by banks will reduce the overall return on equity that banks make and will make it less likely that there will be very large rewards to be made for risk-taking activity, because those risk-taking activities will have to have a lot more capital behind them, and therefore the returns being made on them will be lower. So my hope would be that over time things would change. If you look, there's Andy Haldane at the Bank of England, who is he's perhaps the most interesting person there is on this subject, and it's worth looking at the stuff that he writes. It's all on the Bank of England website. He produced a killer chart a couple of years back, and it was just for the UK. What it showed was the returns on banking in the UK since 1900 relative to the returns on commerce generally. And what that showed was that it was the relationship with the two was very close and moved in a straight line from 1900 to 1985. And then something spectacular happened, which was leverage, essentially. And the returns for a 20-year period sort of zip off the top of the chart before coming back down again. What that was about was leverage. That's why capital is important. And with more capital, I think the need, if there is one, and the possibility of providing the incentives that generate the behaviours we saw will come down sharply. Hope so.
Thank you very much, Sir Lambert. Just two questions. Firstly, yes, there is a general agreement that banks are like central institutions for economic development, but given the lack of this and perhaps our failure in achieving growth and development because of the crisis and all these failures that the markets face. Some people argue that what we see in the banking sector, all this period of crisis, with the bonuses and the incremental increases of the wages of some chief executives, they're immoral and provocative. Could you please elaborate a little bit on that? And secondly, coming from Greece, I got the feeling that structural reform in European level is essential. But what kind of reform would you like to see, or would you expect to see in a European level that would not inhibit banking operation and behavior in the long run? Thank you.
Well, I certainly would agree that behaviours seen in the banking world over the last 25 years have been immoral. Some behaviours have been immoral. My explanation would be that of why this happened. I think there's a whole bunch of different reasons. And regulators are to blame, politicians are to blame. It's not just right to point the fingers at bankers. But what happened over a long period of time was that partly because of the growth of capital surpluses in developing economies and in oil nations, partly because of within Europe, the development of a Eurozone in which for a time Greece could borrow at the same rate as Germany, which with hindsight was not wise. All these things made the sort of norms of behavior in the banking business change, and what would have seemed outlandish behavior in 1980 by 2000 was kind of business standard. It was a slow process of societal change. That's how I look at it. So I'm not kind of like the Archbishop of Canterbury here. I see that although clearly there was wrongdoing, clearly there was immoral behavior, the broad development over the period was more to do with societal changes and macroeconomic changes, which led to norms changing. I think the question about what sort of structural changes are needed in the European in the Eurozone. Personally, I can't see how one can, over time, get to a stable position without some kind of banking union. I can't see how it would be that taxpayers in surplus countries will accommodate themselves with paying off the depositors in troubled banks in deficit countries. And I can't see how a regulatory structure in a single currency can be dispersed, a banking regulatory structure can be dispersed over time in the way that it is. So I think that is necessary. But I also think that it's an argument that seems to ebb and flow according to the state of crisis in the Eurozone. So before Mario Draghi's famous intervention in the spring of last year, it really looked as though a Eurozone, Euro banking union was taking shape. My impression, it's only an impression, there'd be people in this room who know more about it than me, is that the chances of that are dwindling. And I also think that the chances of regulatory change being driven by Brussels, either by Liikanen or Barnier, are slim, with European elections coming up in next month, and a new commission. I don't think people are going to spend the next few months trying to create a new sort of banking system in Europe, and then there'll be a new commission, so we'll be back to square one. So I'm not hugely optimistic about that sort of change taking place anytime soon. I think heavy weight of responsibility lies on the European Central Bank, both as the new supervisor and as a lender of last resort. And I think we're fortunate to have Mr. Draghi at the steering wheel.
We'll just have this question, then one last question in the corner there.
Hi.
Oh, hello. Sorry. Give me a wave.
Hi, yeah, thanks for your talk. On the idea of ring fencing and like removing investment banks' collateral, what do you think in the idea that maybe it's sort of a punishment strategy rather than trying a genuine effort at, targeting the actual problems that caused the financial crisis?
That's a great question. I think that part of the financial crisis, a number of banks failed the old-fashioned way. They made really rotten loans. HBOS was the classic example of that. It didn't have an investment banking arm to speak of, but it just lent money like a drunken sailor, and with the outcomes that we all know about. I think that because of what happened, because of the need to protect depositors, which we now fully understand, before the banking crisis, the depositors in country had trivial taxpayers' guarantees for their deposits. Because of that, I think it is now understandable and probably necessary to build a wall between retail banking and investment banking. There will be, no doubt, consequences of that. People who argue that it's not a good idea say that it'll make it harder for, for certain kinds of medium-sized enterprises to get access to funding and so on and so on. But I think we've been through such a fire that to say we're not going to respond in this way is not plausible. I gather you went to see John Vickers the other day. I don't know if you've seen the video, but I haven't seen the video. But I thought his report was impressive and wise, and I hope it gets implemented.
So, hi. I have a question. So, how are the bank reforms practical with regards to increased activity in money laundering? Increased activity in money laundering.
Well, I don't have a good answer to that. I mean, money laundering legislation has been in place for some time, and there has obviously been inadequacies in the way that it's worked. I'm afraid, I don't think that there's any change proposed in the legislation for money laundering, but I do know for sure that some of the banks that would have been found at fault in money laundering realize that this is an existential risk for their business. For example, one of the most visible cases in the United Kingdom was HSBC, which is a very, very strong bank with a very strong balance sheet and a powerful institution. Actually, I think it's a good bank. But its activities in Mexico failed to meet what the bank expected of it. They were nailed by the authorities properly. So that kind of activity, especially if it's anywhere near the United States, is potentially a bank closing experience now. So I think, I'm not aware of new legislation, which if there is in the UK, if there is, I'm sorry, I wasn't aware of it. But I believe, actually, strongly, that banks now understand that activities in this area are potentially life-threatening for them. Let's hope so.
Okay. I'd just like to thank Sir Lambert for his talk. And he's going to have a short interview now, which you can access later on the YouTube channel. So if you have any outstanding questions, please tweet us at the hashtag WS2014 or comment on our live blog. We can try and get those questions into the interview. Thank you.
Thanks a lot.